on the Sharpe Ratio. Judging an investment's success purely by a flashy average return is a total trap, because it completely ignores the crucial second half of the story, the actual risk you took to get there. First, let's look at the wildness score of risk. Say Fund A averages 5.5%, Fund C gets 2%, the market hits 2.5%, and Fund B averages a massive 8%. Fund B seems like the absolute champ, right? Well, finance measures risk using standard deviation, which is basically a wildness score. Fund B actually has a staggering 17% standard deviation. Earning 8% on a stomach-turning roller coaster is vastly different from a calm, steady return. Second, let's break down the formula. The brilliant economist William F. Sharpe solves this by boiling return and risk into one powerful number. Just take your return, subtract the return of a totally safe asset, like a government bond, to find your excess return, and then divide that by your risk score. The higher the number, the better. Applied here, steady Fund A actually steals the top spot right from under volatile Fund B. Finally, it lets us compare apples to oranges. It's literally a universal yardstick. Take this classic matchup. A stock portfolio with a juicy 12% return and high risk scores a Sharpe ratio of 0.026. Meanwhile, a super conservative bond portfolio with a tiny 4.2% return and low risk scores 0.035. The twist: those bonds are actually the more efficient investment because they deliver way more bang for your buck per unit of risk. Ultimately, the Sharpe ratio fundamentally upgrades how we view investments, forcing us to judge them by their risk-adjusted fuel efficiency rather than just their raw top speed.